Hi everyone, welcome to this month's Financial Markets Update. So after a period of really quite strong financial market performance over the last 3 to 6 months, we certainly saw a recalibration of that during the months of September, with both equity and bond markets significantly sold off during the course of the month. Our local equity market was down around about 2% over September. That was really driven by the sell-off in resources, which was down over 6.5%, and principally on the back of that, the sell-off in iron ore, which was down 25% for the month and continues its decline that we've seen over the last quarter or so as steel demand in China continues to moderate effectively. Nevertheless, other parts of the commodity market really around the energy space, so we saw oil, thermal coal and natural gas continue their upward movement over the course of the month. Thermal coal was up close to 25%, while natural gas was the most significant mover in terms of commodity markets, up over 30% over the course of the month. And we've only got to look to, what we're seeing in the UK, particularly where there's been shortages both of petrol as well as obviously natural gas shortages, has really led to a significant spike in the demand for natural gas right across the board, and that's certainly flowed through into other parts of Europe as well. Bond markets were weaker. Our local bond market was down roughly around about 1.5%, so quite a significant decline on that front. That was driven by yields moving higher right across the curve. Our 10-year bond yield was up over 30 basis points during the month, and global bond markets were also weaker, down around about 1% over the course of September, with US 10-year yields up roughly around about 18 to 20 basis points. That really came off the back of concerns about inflationary pressures continuing to build and continuing to remain elevated relative to expectations of what central banks have certainly thought as it relates to potentially tapering of inflationary expectations through the back end of this year into 2022. And certainly the higher commodity prices have certainly derailed that to some extent, along with the challenges associated with other elements around inflationary pressures, whether it be freight, logistics, price rises, labour pricing, as well as obviously the challenges just simply on cost of goods. And we're seeing that, as I said, particularly in the auto sector, with semiconductors remaining very challenged in terms of the supply side, and that's, as I said, flowing through into pricing. In our view, all of those challenges are going to remain for some time, and we would expect, certainly if we're thinking about some of the core raw materials, the supply side of that is going to, as I said, be a challenge for the global economy, the recovery of the global economy well into 2022. So we think about that in the context of portfolio positioning. Our core view still remains that the growth outlook is in place, albeit that we think it is a little challenged at this point of the market cycle. Delta variant is still having a significant impact on the speed of the reopening of the global economy, and ultimately the impact is being felt in terms of both manufacturing and industrial capacity and the ability of that to be maintained at levels of demand that's warranted, as well as obviously some of the challenges we're seeing, as I said, in things like energy supplies and the like. And that really is going to, as I said, continue to impact, in our view, the outlook for growth over the short to medium term. As we work through that, most likely through the second half of next year, we think that if those challenges can be overcome and if we can start to see those supply bottlenecks start to dissipate, then we do believe that the growth outlook looks relatively sound. But in saying that, central banks will start to move more aggressively in terms of how they think about the policy framework. And equally, we do expect that financial markets, particularly as it relates to bond markets, will start to price in higher rates. And the upward tick that we've seen in bond yields over the last 3 months or so, we think that's going to continue over the course of the rest of this year and certainly into 2022. So from a positioning point of view, we think it's probably one of the more challenging times as it relates to getting that mix between growth and defensive assets right in a portfolio, and the type and nature of both growth and defensive assets, and how to particularly protect against a rising bond rate environment, a rising inflationary environment, and a equity market outlook that is going to look more benign in terms of earnings growth over the next 3 to 6 months or so. And certainly they're the sorts of elements that are certainly occupying our mind from an overall strategy point of view. Notwithstanding that, when we sort of look at the longer term picture, we continue to remain positive on that growth outlook. We do believe there's ongoing stimulus still in the system. We think that's got a while to play through yet, and we think that will ultimately benefit, as I said, growth assets. And as the global economy can reopen, we think that's ultimately going to be a positive for earnings growth over the medium term. But the challenges that we immediately face, I think, in our view, aren't going to go away anytime soon, and we do expect that probably through to the back end of the year, it's going to be a pretty challenging environment for financial markets. And heading into 2022, we do think that also portfolio positions and the asset allocation framework that we've had over the last 12 to 18 months or so will require some refinement, just to make sure that we can stay on top of those challenges as best we can. As always, if you have any concerns about your portfolios, please feel free to reach out to anyone in the team, and we look forward to catching up again soon. Thanks, and bye for now.